from TheoTrade. This is Don Kaufman. It's October 18th, 2019, and you are watching the TheoTrade Weekend Update. So the theme this week is global growth concerns, of course, hitting the markets. But if you watch the markets this week, you would know nothing of the kind. You know, we heard from, well, Chinese GDP. Well, you have to look back a couple of decades to see Chinese GDP as low as it currently is. We had retail sales earlier this week. We even had the IMF, that's the International Monetary Fund, downgrade global growth, specifically also downgrading U.S. growth. And the marketplace, well, it's all about a range. And I'm going to try in just a few minutes, when we kind of get to some of the charts, some of the trade ideas, I'm going to try to describe specifically why that type of trade is in play right now. Again, it's a marketplace that's just not reacting. That's, you know, you're almost feeling like lulled to sleep. Listen, one of the first things you want to recognize is that we are trapped in a relatively tight range. The S&P futures specifically are trading from 2983 on up to about the 3,000 level and have been trapped in that range now for just over a week. Nevertheless, we got a lot of information coming out, right? Economic data this next week is also going to see some heavy economic data. Earnings are flying left and right. And again, the marketplace does not react. More on that in just a moment. Other aspects that you want to kind of think about really moving forward this next week, well, it's all about earnings, as I was mentioning a moment ago. You know, not so much the earnings driving the entire marketplace. Let's not get ahead of ourselves here. Okay, this is not necessarily about earnings driving the whole marketplace, but more or less, I'm just trading earnings. I've been laying on these butterflies in and around earnings, specifically around the expected moves of earnings, and we have actually hit 3 out of 5 butterflies in just the last 3 trading sessions. I'll show you some of the results here in just a couple of moments. So people, traders, start your engines. It's earnings season, and you can anticipate me doing a number of butterflies this coming week. The last thing I want to mention before we kind of get down to some real specifics and dig into a couple of charts and trades has everything to do with the SPX. For those of you that know this, I call the SPX the mother of all products. Well, because, I mean, effectively you're trading almost a $3,000 index product. And the SPX expected move this past week of trade was right around $53. So that means we're supposed to move $53 higher or $53 lower. The interesting aspect is, for the first time in a long time, we did not hit the upper or lower edge of the expected move. What's the reasoning for me mentioning this? Is because this coming week, the expected move has now contracted quite substantially. We're looking at an expected move in the coming week of about $37 and change. And here again is a great trading opportunity. One of the first things I'm going to say about that trading opportunity is, no, I am not selling options premium, because the implied volatility has gone down quite substantially week over week, right? It's one of the big takeaways there. But also, you have to anticipate an extraordinarily high probability at this point of us actually tagging the upper or lower edge of the expected move. Find out here in just a moment what side of that trade I will be taking. With that, let's get down to it. Let's actually show you a couple of charts, a couple of trade ideas, and some specifics behind why we believe that we're range bound. To the charts and trades we go, sticking to the theme, global growth slows, but markets fail to react. You know, I was talking about that range just a moment ago, and here it is. Let me actually show you specifically the range that we have effectively been trapped within. This lower edge right here that is highlighted by a line on the screen. That line happens to be none other than, well, one of our gravity points. It's 2983. The upper edge of this range is just simply a big round number. It's the 3,000 level inside of the S&Ps, and we're just pinging back and forth in those particular levels. So throughout the course of this week, we had Chinese GDP, the IMF, lower growth, or retail sales. There was really poor housing data. I mean, it was just piling on. And the marketplace just stared at it and just kept on moving right along. I mean, maybe a little sell side activity coming later in the week. Specifically, tech got hit a little bit. But if you're kind of curious, what's really going on right now? First of all, on a much larger sense, you have to recognize something about overall markets. Let's forget about the S&Ps for just a second, okay? Put aside what you think about individual company valuations and start to recognize, okay, that there are a tremendous number now of quantitative traders in this marketplace. And, when it comes down to it, like quantitative traders, yeah, sure, some of them mention valuations. You can talk about PE ratios and earnings per share until we're blue in the face. But you also have to recognize, hey, that some of us, okay, trade for reasons other than what we think, a stock is going to do. And if you can fathom that for just a second, I mean, one of the points I'll make is right here inside of the SPX with the expected move. Just bear with me for a second because I'm going to zoom into this because it denotes kind of a larger theme inside of the marketplace. Okay, what you're looking at, these three lines on the screen, well, guess what? I'm actually going to draw directly on them for you to kind of detail this. Now, this happens to be the previous week of trade. That central line right there, that's the starting place, okay, of the week. Meaning that, all right, on a Monday morning, you come in, and that was the previous Friday. Here we are. The upper band, okay, and lower band. That's where the option market kind of depicts us to move. Now, there's a tremendous number of trading firms lately, okay, that will go out and literally they will sell premium inside of that particular range. And as the market starts to drive higher, okay, the firm would have to dynamically hedge that particular position. So the further up we go, what does that trading firm have to do? Well, if they're short premium, all right, when I say short premium, they sold some premium. Specifically, when we go higher, what would happen is that would make them what we call short delta. Now, I don't want to geek out too much on you, but when you're short delta, it kind of means you're short stock. How do you offset a short stock position? Okay, by adding long stock. So they're trying to neutralize, all right, the delta position. And to do so, specifically here in the SPX doesn't even have any stock. You know what they do? They turn around and they buy, okay, ES futures, and they start to drive the markets higher. Well, right now in markets, you're like, well, okay, so that doesn't tell me why we're in a range. Well, I'm getting to that point. Right now, we've had in just the last week of trade, correlation breakdown. With correlation breakdown, basically the advanced decline line starts splitting to 50-50. The gamma, all right, and the delta of this position doesn't get too wild. So effectively what we do is we get trapped in a rather tight range. And the irony of this, it just has absolutely nothing to do with economic conditions. Yes, there can be economic shocks that can hit the marketplace, but if you have a lot of traders, okay, on opposing sides of the position, you get locked in these ranges. And one of the telltale signs of that is when you see things like the advanced decline line hit 50-50, 3, 4, 5 days in a row. That's what we saw this entire last week of trade. All right, the advanced decline line has been a veritable slop fest. In fact, it's been like that over a week. Now, what you start to get is a contraction then in volatility. And as soon as you start to contract in volatility, okay, people are like, well, how are we going to get out of this range? I'll tell you exactly how. We contracted volatility. See, this last week of trade had over a $50 expected move. This next week of trade, and I'll delineate this a little bit more later, okay, now you're actually looking at about a $37 move higher or a $37 move lower. Okay, and what's going to happen is you start to contract this range is there's a much higher probability of touching the upper or lower level. As we actually touch the upper or lower level, I promise you this, all the hedging kicks in. And when the hedging kicks in, it'll actually snap us right back to a correlated state. So you better believe that we are ripe to be a moving. So push aside all of the data over there and just recognize, listen, people trade for reasons that, sometimes you may not understand, that markets aren't necessarily always tied to future value or what you think it should be. Now, let's continue on. Tech takes a hit, but financials hold us together. One of the points that I've been making, okay, extensively week after week after week, pretty much ad nauseum, I talk a lot about the financials, the XLF. Why do I talk about the XLF? Because I always say this. It's the linchpin inside of the marketplace. So the financials have just been a rip-roaring fun time, but they stalled out the last about 4 trading sessions. And as those things stalled out, okay, they've kind of held up the entire market. When I say held it up, they too are inside of a range. Now, granted, the financials, they had earnings this past week at Bank of America, and you had Citi and JP Morgan and Wells. I mean, I can go on for a half an hour about all the different earnings that have come out of the big banks, regional banks. You know, what fun is it if you're not mentioning JP Morgan, right? Push it aside. The irony is that the financials, they finished up today a whopping 7 cents. That actually held the entire market together. You know, we talk about, again, the financials being the linchpin. You better believe that this is important. And interestingly and ironically, the financials, they're through earnings. They're through earnings. So now, okay, the financials, they're going to be ripe to move this next week. And this next week is about a 53-cent expected move. But you better believe these financials, okay, they are going to be on the move, and they're going to be absorbing a lot of the risk of the marketplace. You know, when I actually look over at the expected move inside of the financials, I have to just tell you, with a 16 vol and a 53-cent expected move, I'm a buyer of that. I'm a buyer of that expected move. That means I think we're going to move more than 50 cents inside of the financials. All right. Next thing I want to mention, Boeing. Okay, so just an individual stock I had to throw into the mix over here. And why? Well, Boeing, in large part, it made my week. Boeing kind of did it for me. Roll them if you got them. What I mean by roll them if you got them, I am in, okay, some short positions inside of Boeing. Now, Boeing also has its earnings coming up, so it is what it is. Listen, roll before the earnings, roll before the earnings, roll before your earnings. What I'm saying to you is I already have a position out in December, okay? And I have a deep in the money put. I'm using a deep in the money put as a synthetic, okay, short stock replacement. Effectively, okay, I want to be short Boeing. And the way I did it is by using a deep in the money put. Now, one of my deep in the money puts, I'm out in December. The other one, though, I was able to roll out. I rolled all the way out to January today, people. January 410s. So roll them if you've got them inside of Boeing. Listen, it doesn't matter what you think about the earnings right now. I don't care. If you're in the synthetic short position in Boeing, roll before the earnings. Take some of the risk off the table, right? That's my point. Take some of the risk off the table. All right. Next, I'm going to talk about streamers taking a hit on downgrades. What am I talking about? Streamers. Netflix. Okay, Netflix, there are downgrades a-coming inside of the streaming area. So, you know, when you think about like Netflix getting a downgrade, you know, I'm not that much into upgrades or downgrades, but there's some points to be taken, because in a moment I'm even going to talk about some of the retail stocks kind of taking a hit on some of the downgrades. But when it comes to this, like, I don't look at opportunity in Netflix because it got downgraded. Right? I really don't. All right, the streamers are taking a hit. So you look at Netflix, okay, Captain Obvious, it's down. All right. Then you take a look at something like Roku. All right, Captain Obvious, it's down too. And Roku's been fairly hot. To me, this isn't a story about Netflix. It's not a story about Roku. Okay. The market kind of figured that out too. It's a story about tech growth. All right. Microsoft felt it. Look at this. Microsoft's taking a hit with earnings coming up, right? You can see Facebook also reacting. There is reaction in the tech sector, and I think that this is absolutely unequivocally warranted. Now, I am carrying bearish positions specifically inside of Microsoft, okay? I actually shy a lot away from tech. In fact, you'll find out I'm much more into retail, which I'll mention here momentarily. I shy away from tech. But I want you to think about that these streamers taking a hit on downgrades. And again, a moment ago, I was just talking about how the market almost feels like disconnected. Okay. Yeah, it feels disconnected until, okay, there is proof in the pudding. And that is, if one of the big techs does come out this week, and again, I'm citing Microsoft, that has the slightest miss, they are going to decimate, absolutely decimate technology. I wanted you to see this because the monsters of tech, this is a conglomerate symbol that we built, the monsters of tech were down just over 1% today. And I think the irony of that is that the S&Ps were only down 0.29%. Again, what gives? Okay, what gives is the financials held them up. Nevertheless, streamers taking a hit on downgrades is much more of a story of, again, it is global growth concerns, and it's tech concerns specifically. Moving on, retail stocks taking a hit on downgrades. It was a downgrading party today. All right, let's start with Macys. Now, this is something that just infuriates me. I've been trading now since the late 90s, and what infuriates me more than anything is when a major bank or institution comes out and downgrades a stock like Macys. All right. By the way, this is Credit Suisse. Okay. In all of the wisdom, allowed one of their analysts to downgrade a stock that was already down. Hey, listen, it was already down like, 48%. Let's just downgrade it and make it down 50%. Okay. Macys, Gap, Nordstrom's. In fact, all of them. Okay. And again, I'm going to make the same point. They received downgrades. And interestingly enough, Nordstrom's not half bad, on some of this. But this downgrade, okay, cited some really detailed information saying that, hey, we expect now a slowdown to the retailers. Yeah, but by the way, there's nothing to know about like Macys or Nordstrom's or any of the other retailers. Like, look, it's already down 50%. You kind of beating a dead horse to death over here talking about downgrading it. What you have to look at this as is an opportunity. You have to ask yourself, but what about the retailers, okay, that are just smiling and laughing all the way? Let's go to Lulu. You realize it's up almost 70% on a year-to-date basis. How come it's completely unimpeded? In fact, cracks into, wait for it. You can bring up a 3-year. You can bring up a 5-year. You can bring up an all-time chart. It don't matter because Lulu hit an all-time high today. This is the kind of disconnect that I look for because this is going to be advantageous. If retailers are going to start to take a hit, eventually they're going to turn, all right, and they're going to fire algorithms directly at something like Lulu. So be aware of that. Where are they also going to look? Nike also hitting an all-time high today, right? You can't make this stuff up. Listen, you have a major banking institution, which I was poking fun at because they downgraded a stock that's down 50%, but nobody wants to take, the guts and say downgrade Lulu, downgrade Nike. I will, okay? They wait. Okay, they wait until after there's already sell-side activity to downgrade it. I wouldn't. I like short Lulu, short Nike. Okay, I'm even looking at something like Costco. Now, Costco, this is a dangerous place to play. Effectively sitting very near an all-time high. I'm less likely to want to short into Costco, at least at this point in time, because it's sitting, and you have to pull up a very substantial chart here right off of its all-time high. High likelihood of cracking through that before possibly disintegrating. But if you're thinking about retail stocks and I'm looking for something to short, and you can see retailers are getting hit. Now there's a difference because these are considered like softline retail. Listen, retail eventually is retail. If there's going to be a slowdown in retail, they're going to come for you, Lulu. Okay, what are they going to do? Like, no. In the end, I'm going to drop my Netflix subscribing service, but I got to go out and buy me some $120 yoga pants. I'm sorry, I can't get over how much stuff at Lulu costs. I'll push that aside for a second. All right, onward and upward. Big earnings are coming. Traders, start your butterflies. Listen, earnings. What I have here is like a little bit of a scan built for earnings. Has earnings anytime in the next 4 days. A couple of the little features built into the scan. Nevertheless, some of the big boys are coming out, and you better believe I'm going to be all over this. I had a little bit of an earnings butterfly party myself this past week. So I'll cruise over. This is just the last 7 days. And I wanted to show you a couple things. First of all, I got a little butterfly happy this week. Okay, so I like to route orders like this. And anyway, the butterflies that work, the butterflies that didn't necessarily work. Okay, I hit an IBM butterfly right here for almost $1 credit. I hit CSX butterflies here for 83 cents credit. I also sold some for 46 cents, not necessarily as good. I also hit last minute an American Express butterfly. Got a little bit of my money back. I missed a butterfly on Netflix, but I lost a whopping 24 cents, and missed one on Morgan Stanley for 18 cents. But net a spectacular week. I mean, I did 5 butterflies and hit on them. By the way, I wanted to show you American Express because this one, This one came up almost to bite me here. American Express, I completely missed the butterfly as of this morning. But if you look at the time I closed this thing, like 2 minutes before the close, it went in the money, and I actually wiggled out of it like a vertical spread. So I paid 23 cents for it, got out of it for 29 cents. Let's call that one a wash. So still, though, the statistics of this are absolutely spectacular. When I say the statistics are spectacular, you realize, you have to put this into perspective for a second. I just did 5 butterflies, and 3 out of the 5 of them hit some pay dirt. You think about that for a second, because when you look at a butterfly, all right, and what you're paying for it, and I'll give you an example over here. The IBM butterfly only had like a 10% probability, right? The Netflix butterfly only had a 4% probability of hitting. I missed the Netflix one. That's fine. The CSX butterfly, had about an 18% hitting. But at the same time, I just pulled 3 out of 5. It's working, people. So with earnings coming, believe me, we're going to be trading some butterflies this next week. To kind of wrap things up, I was talking about the SPX on the way in over here, and I'm gonna leave you with this thought. Again, the SPX, and talking about butterflies, the SPX this next week has a very high probability of actually touching the upper or lower edge. I kind of suggest, get your expected move butterfly in place, which you can pick it higher or lower. I got to tell you, in this next week of trade, I'm actually going to take a shot to the downside. Why? Well, really it has a lot to do with tech, and I believe that the XLF is likely to follow suit. That's my own kind of bias thrown on the week over here. Again, this past week of trade, it's all about global growth. It's slowing. The markets failed to react, but hey, that is not going to last. I believe you're actually going to crack the range this next week, and we'll be back on Mr. Toad's Wild Ride. Have a wonderful weekend, everybody. Bye-bye.